Chapter 6 Lev- Financial IQ 4 Leveraging Your Money. On August 9, 2007, the stock market plunged nearly 400 points. The Federal Reserve and central banks around the world began injecting millions in cash into the economy to make sure the panic didn't spread. The market was still nervous the next day. As I was getting ready for the day, a newscaster on a morning television program was interviewing three financial planners and getting their opinions. Their unanimous advice was don't panic, stay the course. When asked for further advice, all three said save money, get out of debt, and invest for long term in a well diversified portfolio of mutual funds. As I finished shaving, I wondered if these financial experts had all gone to the same school for parrots. Finally, one advisor took a moment to say something different. She began by condemning the real estate market for causing the mess in the stock market, blaming greedy investors, unscrupulous real estate agents, and predatory mortgage lenders for causing the subprime mortgage mess which led to the crash in the stock market. This advisor said, I told my clients that real estate was risky, and my advice has not changed. Real estate is a risky investment, and investors should invest for the long term in blue chip stocks and mutual funds. As the financial planner on television was ending her attack on real estate, my wife Kim walked into the room and said, remember, we have a closing today on the 300-unit apartment house. Nodding my head, I said, I'll be there. As I finished dressing, I thought it's funny the financial advisor saying that investing in real estate is risky. The real estate markets are crashing at the same time Kim and I are buying a $17 million apartment in Tulsa, Oklahoma, and we are excited about it. Are we on the same planet? The new capitalism. On August 9 and 10, 2007, an investor lost billions of dollars. The US Federal Reserve Bank was injecting billions of dollars into the banking system, doing its best to stop the panic in the real estate, stock, and bond markets. This injection of capital is an example of how the new capitalism operates, an economic system built on debt and manipulation by central bankers playing games with the world's money supply. It's almost like you and I using credit card to pay our credit card bills. Later that week, I was asked to be a guest on 2 television and 3 radio programs to comment on the crash. The hosts wanted to know what I thought about it, as well as what I thought about the Federal Reserve injecting cash into a crashing market, and whether the Federal Reserve Bank should save the market by lowering interest rates. In all of my interviews, I said I don't like the central banks manipulating the markets. I don't feel the government should bail out the rich hedge funds and financial institutions, shielding them from their own greedy mistakes. I also said I do feel for the little guy. In one day, millions of hardworking people who do not play games with money watch their homes decline in value in the real estate market. Their savings decline in value in the bond market, and their retirement portfolio decline in value in the stock market. When asked if I was continuing to invest, I said yes. When asked if I thought it was risky to be investing in crashing market, I replied there is always a risk. I then completed my thoughts by saying the ups and downs of markets do not affect why I invest or what I invest in. 2 points of view. Although the question was not asked, I thought a better question might be what is the difference between the financial planner who was negative on real estate and my point of view about investing in real estate. Or why, while so many people were panicking, I was excited about buying more property? The answer to these questions are provided in this chapter through 2 financial concepts, control and leverage. As stated repeatedly in this book, the rules of money changed after 1971 and 1974. There are new rules and new capitalism. In 1974, millions of workers began losing their paychecks for life, known as a defined benefit pension. They now had to save and invest for their retirement in defined contribution pension plans. The problem is most people have very little financial training or education in order to invest for their retirement property. Another problem is the new rules of capitalism require workers to invest in assets they have no control or no leverage over. During market crashes, all almost can do is watch helplessly as the financial hurricane whipsaws their wealth and financial security. The new capitalism puts millions of workers' money into investments that allow them very little control or leverage. Because I have control over my investments, in this example, a 300 unit apartment house, I am not as affected by market crashes because I have control. I am confident about using a lot more leverage. Due to control and leverage, I can achieve greater wealth in less time with very little risk and minimize the effect of booms and busts of markets on my investments. The market has been crashing for a long time. As I write earlier, USA Today did a survey and found that the greatest fear in America was not terrorism, but the fear of running out of money during retirement. After August 9 and 10, 2007, I am sure that fear spread a little further. The people who are worried have good reasons to worry. When when you look at the two charts below, you can see the effect of the rule changed in 1971 and 1974 on the value of the stock market. As you can see, the market has actually been crashing for a long time. Just like housing, as the Dow is going up in price, its purchasing power is actually coming down. This loss of monetary purchasing powers makes the financial future of most workers less secure. These charts say their future will cost them more money and become more expensive. Without leverage, most workers cannot put enough money aside for their future because the more money they save, the less valuable it becomes. There is a funny story about the German economy just before Hitler came to power that illustrates this concept. The story goes that a woman took a wheelbarrow filled with money to the bakery to buy a loaf of bread. After negotiating a price for the bread, she came out of the bakery to get her money, only to find that someone had stolen her wheelbarrow and left her money. This is happening to the American saver. How much will a retired person need in saving to afford retirement in such an inflationary economy? What happens if you are retired and need life-saving surgery, which government medical program will not pay for? What do you do if your problem is not having enough money to retire on? That is why financial IQ number 4, leveraging your money, is so important. Leverage makes your money work harder for you by using others people monies. And if you have financial IQ 3, if you have a high financial IQ number 3, you can pay less and less in taxes. What is leverage? In very simple terms, the definition of leverage is doing more with less. A person who puts money in the bank, for example, has no leverage. It's the person's money. A dollar in savings has a leverage factor of 1:1. The saver puts all the money. For my investment in the 300 unit apartment house, my banker puts up 80% of the 17 million real estate investment. By using my banker's money, my leverage is 1:4. For every dollar I invest in the deal, the bank lends me $4. So why did the financial planner on TV says that real estate was such a risky investment? Once again, the answer is control. If an investor lacks the financial intelligence to control the investment, the use of leverage is very risky. Since most financial planners put money into investment where they have no control, they should not use leverage. Using leverage to invest in something you do not control would be like buying a car without a steering wheel and then stomping on the gas pedal. Most of the people being hurt by the real estate meltdown are people who were counting on the real estate market to keep going up and increasing their home's value. Many people borrowed money against their inflated home value. Now their home may be worth less than what they owe. They have no control over the investment and are at the mercy of the market. Many homeowners who still can make their mortgage payments feel bad because the value of their home has dropped. They watch the equity of their home disappear. When housing prices drop, many homeowners feel they have lost money. This is sometimes referred to as the wealth effect due to inflation, which is not really an increase in asset value but a decline in purchasing power of the dollar. Many people feel wealthier as their home's value appear to increase. When they feel wealthier, they borrow more money, leverage, and spend more money on liabilities. This is the direct result of the new capitalism, an economic expansion based upon the decline of the dollar and increase in debt. My worth is not based upon net worth. The wealth effect is rooted in the illusion of the net worth. The net worth is the value of your possessions minus your debt. When a house goes up in the value, most people feel their net worth has gone up. For those of you who have read my other books, you may already know that I feel net worth is worthless for three reasons. Net Net worth is often an estimate based upon opinions, not facts. The value of a home is only an estimate. You will not know the true price until the house is sold. This means many people overinflate their home's estimated value. Only until they sell their home they will know the facts. The real price and the real value. Unfortunately, many people may have already borrowed against the perceived value of their house and may owe more than they can sell the house for. Net worth is often based upon possessions that have a declining value. When I fill out a credit application, I am allowed to list most of my possessions in the asset column. I am allowed to list my business suits, shirts, ties, and shoes as assets, just as I can list my cars. You and I know that a used shirt has a very little value and a used car has considerably less value than a new car. Net worth going up is often caused by the dollar going down. Some of the appreciated value of a house is due to the decline in value of the dollar. In other words, the house is not going up in value, it just takes more dollars to buy the same house because the government and central bank keeps injecting more funny money into the system to keep the economy afloat and to keep the feel-good illusion of prosperity alive. A politician's greatest fear. The reason I use the word feel-good illusion of prosperity is because the greatest fear of politicians and bureaucrats is people feeling bad. Throughout history, kings, queens, and rulers have been overthrown and being executed when the people feel bad. You may recall the French people chopped off the head of their queen, and the Russian people executed the last Caesar, his wife, and his kids. The old capitalism was based upon tough economic fundamentals. This new capitalism is based upon feel-good economics. As long as a person's net worth is going up, the illusion of prosperity based upon debt, not production, continues. Who needs freedom when you have got things? As long as the world economy allows the US government and the US consumer to borrow and spend, the fairy tale global economy will continue. If the dream turns into a nightmare and the feel good bubble burst, heads will roll again. They may not roll physically, but heads will roll politically, professionally, and financially. Value not based upon inflation. The value of my $17 million apartment house is not based upon inflation or the price of the building. While price is important, I am not continuing on the price of the building going up due to some magical unseen market condition. I am not continuing on an increase in net worth to feel good, or worrying about a market crash and feeling bad. That is why the booms and busts of the markets do not concern me that much. The value of my apartment house is based upon the rent my tenants pay. In other words, the true value of the property is the value my tenants think the property is worth. If a renter thinks the apartment is a good value at $500 a month, that is the property's value. If I can increase the perceived value of my property to my tenants, I, not the market, have increased the value of the property. If I increase rents without an increase in perceived value, the tenants moves to the community down the street. The value of real estate in this case my apartment houses is dependent on jobs, salaries, demographics, local industry, and supply and demand of affordable housing. In a housing crash, the demand for rental units often goes up, which means demand and rents go up. If rents go up, the value of my rental real estate may go up, even if the value of residential real estate is coming down. There are three specific reasons why I'm not concerned about market crashes when it comes to the purchase of my 300 unit apartment house. One reason is because Tulsa, Oklahoma is an oil boom town. High paying jobs are plentiful. The oil industry needs workers, and transient workers need rental housing. The second reason is because a local college near the apartment house is doubling its number of students but not the number of on-campus housing units, which increases demands for rental apartments. As many of you know, there is another baby boom coming, referred to as the eco boomers, a generation just now entering college, which is 73 million strong. A majority of them will be renters. The third reason is because the fixed interest rate on the existing loan is very low. Low interest payments, lower expenses, and increasing income will increase property value, not market in fluctuations. This means that the 300 unit apartment house offers me both control and leverage. My job as an investor on this apartment house is to increase my leverage from 1:4 to possibly 1:10. That is doubling the value of the property through operations, not the market. I can do that as long as I have control. Leverage is not risky. Many financial advisors will tell you that higher returns means higher risk. In other words, leverage is risky. That is absolutely false. Leverage is risky when people invest in assets that they have no control over. If a person has control, leverage can be applied with very little risk. The reason most financial advisors say that higher returns means higher risk is simply because they sell only investments that allow very little control. As mentioned above, my $17 million apartment house in Tulsa is a good investment to use leverage with, because I have control over the operations, and the operations, that is the amount of income that is collected through rents, determine the value of the investment. A house is not a good investment and leverage is risky with a house because you do not control the value of the house. The value of a house is based on the market and the purchasing power of the currency it was purchased with. These things are out of your control. What is control? The major flaw in paper assets such as savings, stocks, bonds, mutual funds, and the index funds is a lack of control. And because you have no proper control, it is difficult and risky to apply leverage. Because these paper assets offer very little control, it is difficult to get a bank to lend you any money to invest in these assets. So what is control? The diagram of the financial. Okay. So income statement should be sales and rents, and expense should be operational costs. And the balance sheet is assets is business and real estate, and liabilities is the debt. As an entrepreneur, I have control over the 4 columns in the financial statement of my business. As a real estate investor, I have control over the four columns of the financial statement of my investment. Financial intelligence is the key to control. Financial intelligence is the key to control. Financial intelligence increases control, and the financial IQ measures the financial returns of financial intelligence. Take the example of my apartment. Number one, the income column. The first step after acquiring the property is to increase the rent. The property is already profitable and cash flows with existing rents. In other words, I am already making money from day one. Even so, the objective or business plan is to raise the rent per unit an additional $100 a month over the next 3 years by the following means. Number one, raising the existing rents that are under market. Number two, installing washers and dryers in all the units and charging extra for rent. Number three, completing improvements to the property like landscaping and new paint. All of these can be completed by using the bank's money, not mine. When we provided the bank our business plan, these improvements were part of it, and were factored into the total loan amount. Multiplying 300 unit by $100 over 3 years, this increases the entire project monthly income by $30,000 a month, or an additional $36,000 a year. This increase in income is an example of control and leverage. If the plan works, 3 years from now, my financial IQ number 4, leverage, will be infinite, because the increase in income will be achieved by no additional capital from investors, just good knowledge of how to manage the asset, control to higher and higher profitability. The increase in financial IQ is infinite because the increase in income will be achieved using investor control and the bank's money. The expense column. The next controllable objective is to lower expenses. This is done in different ways. One specific example is by reducing labor costs through reduced administrative costs. Since we own other properties, many costs can be brought back to the main company. These are sometimes called back office expenses. They are the costs of accountants, bookkeepers, attorneys, and administrative staff. Other expenses that can come down are insurance, property taxes, water consumption, maintenance, and landscaping, through better cost management and economy of scale. Also, expenses can be reduced and income can go up by keeping turnover low. The time it takes to re-rent an apartment, for example, the moment a tenant informs the management company that he or she is leaving, an ad is run advertising the apartment's availability. Once vacated, the cleaning crew comes in that day, and the apartment is ready to show to potential new tenant that night. And in many cases, an apartment is rented before the existing tenant even moves out. Obviously, many incompetent investor fails to reduce expenses and actually increase them, making the property a bad investment for them. Often they fail to manage the quality of tenants and the attractiveness of the property because they are trying to save money. In most cases, the property goes down in the value. It's these poorly run properties that we like to buy because we can turn them into good investments through good property management. In other words, we make good money from bad investors. Property management is a key to control. As you know, property management is one of the keys to profitability of real estate. Property management is the key control. Like most investors, I hate property management. That is why I have Ken McElroy, author of the ABCs of Real Estate Investing, as a partner. His company is absolutely the best. If you would like more information on property management or how to increase the value of the real estate through property management, the return offer. Okay. So it offers many audiobooks created by the friend Ken. One of the reasons why I say clear of most stocks and mutual funds is because I have no control over expenses, especially management salaries, bonuses, and fees. It takes me sick to read about greedy CEOs increasing in pay even as shareholder values drops. For example, Robert, CEO of Home Depot, was being paid $38 million a year in salary plus a guaranteed $3 million bonus each year. Unfortunately, things didn't go well with him and he finally resigned, but only after the board of directors agreed to pay him $210 million to do it. To me, this is excessively expensive and a rip-off. That is why I don't like paper asset. Most people asset are run by MBAs, employees who think more about their personal finances than their investors' financial security. By the way, Home Depot executive compensation, while high, is not necessarily exemption, it's the norm. The liability column. My 300 unit apartment house had an existing mortgage interest rate of just 4.95%. The low interest rate increases the asset value of the entire property by adding a second mortgage at 6.5%. We created a blended rate of about 5.5%, taking into account the different amounts of the two loans. This low interest rate is an important control and leverage. A percentage point on millions of dollars has a great impact on net worth. For example, a 1% saving on a 10 million mortgage is 100,000 US dollars is an extra income annually, as the diagram below illustrates. Reducing debt and increasing in rate expense on debt is also an important part of the leverage. The asset column. By increasing rents, reducing expenses, and reducing debt or increase on debt, the asset value of the property increases. As you can see, by the financial statement, having controls and getting numbers to move in the desired direction are a form of leverage and a function of financial intelligence. Bobbing for apples. Bobbing for apples. Today, with the ups and downs of the market, many investors look like old-time carnivalgos goers who robbed for apples floating in a tub of water. It looks like fun, but it's not something I want to do every day just to make a buck. Rather than watching the price of my stock or mutual fund bob up and down in the market, I want control over my financial statement by having the financial intelligence to control income, expenses, debt, and ultimately the value of my investment. I have control over my financial destiny. The investor has no control and no leverage power in any of the four columns of the financial statement, with savings, stocks, bonds, mutual funds, or index funds. A pause before going on. Before going on into higher forms of leverage and control, I believe it's important to recap and review the points covered so far before getting more complex. There are several points. There are many types. Point 1. There are many types of leverage. The financial leverage most people are familiar with is the leverage of debt, also known as OPM, other people's money. There are other types of financial leverage, such as the leverage of financial intelligence applied to financial controls. In fact, all five financial intelligences, which are increasing income, protection from predators, budgeting, leverage, and information, are a form of leverage. Leverage is anything that makes your life a little easier. It's easier to move a heavy object with a forklift, and it's easier to make a sophisticated investment decision with a higher financial IQ. Point 2. Most investors invest in paper assets they have very little control over. Examples of paper assets are savings, stocks, bonds, and mutual funds, and index funds. Because these assets allow little to no control, these investors have very little leverage and low returns on investment and reflect on low financial IQ. An example of no financial IQ is a 5% return on savings paying taxes on that return, and then having inflation almost wipe out of its money, its value. Point number 3, increase in returns does not mean an increase in risk. When financial advisors say that an increase in returns means an increase in risk, they are right when speaking about paper assets. They are wrong when speaking for all assets. Assets such as business or real estate require more financial intelligence, allow for more financial control, and permit a higher degree of leverage with very low risk. The key to low risk is higher financial intelligence. That is why I recommend that people start small and stay small. And as they allow their financial intelligence to increase, with an increase in financial intelligence, their returns on their investment increase. If financial intelligence is low, then leverage may deliver a blow to financial IQ, the measured returns on that investments. Point number 5, most financial advisors are not investors. Financial advisors are simply salespeople. Most financial advisors, even many real estate brokers, invest only in paper assets if they invest at all. Most have very little leverage professionally and financially. In many cases, their professional and financial leverage ratios are 1:1. A 1:1 professional ratio means they get paid for their work and only their work, a day's pay or a day's work. As a business owner, I have thousands of people working to assist me. As an investor, like in the example of the Tulsa apartment house, I have 300 tenants helping me pay for my investment. The bank lending me $4 for every one of my dollar, and the tax department giving me tax breaks on my income. These are examples of different types of leverage. Point number 5, financial education increases financial intelligence. Most people invest in paper assets such as savings, stocks, bonds, and mutual funds and index funds because they do not need or want control. All they want is to turn their money over to an investment advisors who hopefully does a good job. Out of sight, out of mind. If people want more control, the first thing they need to control is their financial education, which increases their financial intelligence and hopefully increases their financial controls and leverage ratios. Point number 6, leverage can work in two ways. Leverage can make you rich and leverage can make you poor. That is why leverage requires financial intelligence and financial controls. With stocks, a trader can use the leverage of options. If a trader thinks the market is going up, the trader may use a call option, which is the right to purchase a stock at a certain price with a certain time. For example, if the stock is $10 today and the trader senses the price will go higher, the trader may buy a call option for $1. If the trader is correct and the stock goes to $20, the trader has made $10 with $1. If the trader thinks the market is going down, the trader may use a put option or short the stock. In other words, a trader has the potential to make money if the stock price is going up or down. The problem, however, is that the trader has no control over the asset, just control over the terms of their trade. As expected, most financial advisors who sell mutual funds and recommend diversification say that trading a stock is risky, and it is for those who lack training and experience. Learning and trade a market, even in real estate, is an important part of an investor's financial education. Real estate investors also use options. In real estate, a call option is known as a down payment. If you are a flipper, a down market in real estate can be disastrous. Since most of my investment in real estate is based upon rental prices and operating costs of a property, up and down markets in real estate do not affect me as much. While I do occasionally flip a property, especially if someone is willing to pay me a ridiculous price for it, as a practice I would rather buy a property and collect rent and other income for a long time. Then I look for another property to buy and hold. For those who are interested in learning about investing in up and down markets, we have our board game Cashflow 202, a game that teaches you to trade with play money. Cash flow 202 is an addition to cash flow 101. It is strongly recommended you start with cash flow 101 before moving on to cash flow 202. There are cash flow clubs all over the world for people who want to learn the games before purchasing them. Financial education is essential for anyone wanting to use more leverage. Point number 7. When most financial advisors recommend diversification, they are not really diversifying. There are two reasons why the diversification they recommend is not diversification. The first reason is that financial advisors invest in only one category of assets, paper assets. As the market crash of August 2007 revealed, diversification did not protect paper asset values. The second reason is that a mutual fund is already a diversified investment. It is a hodgepodge of good and bad stocks. When a person buys several mutual funds, it is like taking several multivitamins. When a person takes several multivitamins, the only thing that goes up in value is the person's urine. Professional investors don't diversify. As Warren Buffett said, diversification is a protection against ignorance. Diversification is not required if a person knows what they're doing. My rich dad would say, whose ignorance are you protecting yourself against? Your ignorance, your advisor's ignorance, or your combined ignorance? Instead of diversify, professional investors do two things. One is to focus only on great investments. This saves money and increases returns. The second is to hedge. Hedging is another term for insurance. For example, my 300-unit apartment house is required by the bank to have all sorts of insurance. If the property burns down, insurance pays my mortgage and rebuilds the building. Best of all, the cost of the insurance is paid out of the rental, its income itself. Two of the main reasons I do not like mutual funds is that banks do not lend money on them, and insurance companies will not sell me insurance against catastrophic loss if the market crashes, and all market crash. On to more leverage, high returns, and lower risk. Focus, not diversification, is the key to more sophisticated leverage, high returns, and lower risks. Focus requires more financial intelligence. Financial intelligence begins with knowing what you are investing in for. For the world of money, there are two things for investors invest in: capital gains and cash flow. Capital gains. Another reasons so many people think investing is risky is because they invest for capital gains. In most cases, investing for capital gains is gambling or speculation. When a person says, I am buying this stock, mutual fund, or piece of real estate, he or she is investing for capital gains, an increase in the price of the asset. For example, if I had purchased a $17 million apartment house, hoping I could sell it for 25 million, then I would be investing for capital gain. As many of you know, investing for capital gains means a tax increase in some countries. Cash flow. Investing for cash flow is a lot less risky. Investing for cash flow is investing for income. If I put savings in the bank and receive 5% in interest, I am investing for cash flow. While interest is a low risk, the problem with savings is the return is low. Taxes can be high, and the dollar keeps losing value. When I purchased the 300-unit apartment house, I was investing for cash flow. The difference is I was investing for cash flow using my banker's money for a higher return on investment and paying less in taxes. That is a better use of leverage. What are you investing for? Most financial advisors recommend that a person invest in growth funds when he or she is young. Investing for growth is investing for capital gains. They advise older investors to then shift into shift their growth funds into income funds or annuities. In other words, invest for cash flow when you are older. They believe cash flow is less risky and more certain. Three types of investors. One, those who invest only for capital gains. In the world of stocks, these people are called traders, and in the real estate market, they are called flippers. Their investment objective was generally to buy low and sell high. When you look at the cash flow quadrant, traders and flippers are actually in the S quadrant, not the I quadrant. They are considered professional traders, not investors. On top of that, in America, traders and flippers are taxed at a higher S quadrant tax rate and do not enjoy the benefits of the tax break the I quadrant receives. Though number two, those who invest for only for cash flow. Many investors like savings or bonds because of the steady income. Some investors have love municipal bonds because they pay a tax-free return. For example, if an investor buys a tax-free municipal bond paying 7% interest, the effective return on investment ROI is the same as receiving a 9% taxable return. In real estate, many investors have triple net leases (NNN). With NNNs, investor receives income without the expenses of taxes, repairs, and insurance. The tenants covers those costs. In many ways, a triple net lease is like a municipal bond because a lot of the income can be tax free or tax deferred. While I love triple net properties as expected, the trouble is finding a good property with a good tenant willing to pay a good return. Today, as I write, most NNN's properties are only paying about a 5% or 6% return. Not that exciting. The good news is that if I dig deeper, which I will go into later, I might be able to find a property with a much higher return, all the while using more leverage and my bank's money to lower my risk, which is why I prefer triple net real estate over tax-free municipal bonds. This leads us to the third type of investor, the investor who invests for capital gains as well as cash flows. Years ago, old-time stock investors invested for both capital gains and cash flow. Old timers still talk about the price of a stock going up as well as paying the investor a dividend. But that was the old economy, the old capitalism. In the new capitalism, most paper investors are looking for the quick buck to make a killing. Today, the big investment houses are hiring the smartest whiz kids out of the college and using the power of supercomputers and computer models to look for the slightest market patterns they can exploit. For example, if the computer picks up a 1% differential, let's say in tech stock, the investment house will bet millions of dollars hoping to gain 1% of dollars in a few years, in a few hours. This is very high leverage and very risky. These computer models can also cause a lot of volatility in the markets and often cause crashes. When the stock market announces that program trading has been halted, it is talking about these computer programs being halted. The market crashes if the computers say sell. If the computers say buy, the market booms, and then they crash. In other words, the prices can go up and down for no fundamentals or business reasons at all. A stock price may have no relationship to the value of the company because the computers created an artificial supply or demand. If you recall the dot-com era, companies that were not companies but rather just good ideas were valued at billions of dollars, and companies that were really valuable had their share prices trashed when the dot-com boom busted. As an old-time investor in this era of capitalism, I must be smart enough to invest for capital gains, cash flow, leverage of debt, and a tax advantage, as well as be above the turmoil the whiz kids and supercomputers cause in the market. For instance, I recently purchased a stock even though I do not have control because the company, an old boring industrial age company, historically pays a steady 11% dividend. When the share price dropped in the recent crash market, I bought the stock because the price of the cash flow became cheaper. So I do occasionally buy paper assets, but I tend to buy for cash flow. Being a little guy and not having control over the company, I do not use leverage. I only invest with cash flow I can afford to lose if I am wrong. If this particular store goes up in price, I may sell because I like investing for both cash flow and capital gains. My ROI, return on investment, goes up if and when I can receive both cash flow and capital gains.